In a narrow corridor of water just 21 miles wide at its most constrained point, a fifth of the world's oil supply passes each day under constant surveillance. Tankers move in predictable lanes. Insurance rates adjust in real time. Naval patrols maintain distance, but never absence. This geography has not changed in decades. What has changed is the pricing signal now emerging from it. Brent crude crossed a threshold that markets once treated as temporary. This time, the response was different. There was no immediate correction, no coordinated release that restored equilibrium. Instead, contracts adjusted upward and remained there, quietly, almost as if the system had accepted a new baseline. The explanation offered publicly focuses on supply constraints and regional tension. That explanation is not incorrect. It is incomplete, because price is not only a reflection of scarcity, it is a reflection of expectation, and expectation is shaped by decisions that are rarely announced. Somewhere between the tanker routes and the trading floors, a shift has occurred in how risk is being priced into the future, not just the present. If energy prices stabilize at this level, which part of your economy absorbs the cost first, and which part cannot absorb it at all? He examines movements others reduce to headlines, following shipping lanes, contract structures, and policy signals that rarely appear together in a single narrative. Professor Liang Wu approaches markets as systems of power rather than numbers on a screen. His work begins where simplified explanations stop. If you want analysis that traces the underlying mechanics rather than the visible reaction, you may consider subscribing, because this kind of examination continues only where there is sustained attention to detail and pattern. The significance of oil reaching this level in 2026 extends far beyond a single commodity price. According to the U.S. Energy Information Administration, global petroleum consumption continues to exceed 100 million barrels per day. At that scale, even a modest increase per barrel translates into substantial shifts across entire economies. Energy is not an isolated input. It is embedded in transportation, manufacturing, agriculture, and electricity generation. When the price rises and remains elevated, it transmits through supply chains into consumer prices, industrial costs, and national inflation rates. The International Monetary Fund has repeatedly identified energy price shocks as a primary driver of inflation volatility, particularly in import-dependent economies. Countries with limited domestic production face immediate exposure. Currency pressure follows. Trade balances adjust. Policy responses become constrained. Central banks may tighten monetary conditions, but energy-driven inflation is resistant to traditional tools. This creates a feedback loop where economic growth slows, while costs remain elevated. At the same time, production dynamics are evolving. The organization of the petroleum exporting countries and its partners continue to manage output through coordinated agreements, adjusting supply to stabilize or influence price ranges. According to publicly reported OPEC+ decisions, production cuts have been extended or recalibrated in response to market conditions. These decisions are not purely economic. They reflect strategic calculations about revenue, market share, and geopolitical leverage. The United States remains a major producer, yet its capacity to offset global supply constraints is not unlimited. Shale production responds to price signals, but it is influenced by capital discipline, regulatory conditions, and infrastructure limits. According to Verify, insert accurate U.S. production figure, output levels remain significant, yet insufficient to unilaterally stabilize global markets under sustained external pressure. Now consider the intersection of these factors. High prices persist when supply is managed, demand remains resilient, and risk perception increases simultaneously. The Strait of Hormuz remains a critical choke point, with the U.S. Energy Information Administration estimating roughly 20% of global petroleum flows passing through it. Any perceived threat to this passage is priced into markets immediately, regardless of whether disruption occurs. What is at stake is not simply cost. It is predictability. When markets lose confidence in stable pricing, planning horizons shrink. Investment decisions become cautious. Governments intervene more frequently, and households feel the impact directly, often before policy responses can take effect. To understand why this price level may not behave as previous spikes have, we need to examine the deeper forces shaping both supply decisions and risk perception simultaneously. The first angle is not price itself, but the deliberate management of supply behind that price. At the surface level, oil reaching this threshold appears to be the result of tightening supply and resilient demand. Production cuts announced by OPEC and its partners have reduced available barrels in the market. These decisions are public, documented, and framed as necessary to maintain market stability. According to official OPEC communications and reporting, coordinated output reductions have been extended into 2026 to manage price volatility. This is the visible layer. But the visible layer is only the beginning. Production cuts are not simply economic adjustments. They are instruments of control. By removing supply from the market, producers influence not only current prices, but expectations about future availability. Expectations shape investment, consumption, and policy responses. When markets begin to anticipate constrained supply over an extended period, prices adjust upward even without immediate shortage. Now consider the deeper implication. OPEC Plus is not a monolithic actor. It is a coalition of states with overlapping but not identical interests. Saudi Arabia seeks to balance revenue generation with long-term market stability. Russia, operating under sanctions, requires sustained higher prices to offset discounted sales. Smaller producers depend on consistent income to support domestic budgets. Each member enters negotiations with different constraints, yet the outcome is coordinated action. This coordination is itself a form of power. The ability to influence global prices through collective decision-making places producers in a position where they can shape economic conditions far beyond their borders. Energy-importing countries, including major economies in Europe and Asia, become price takers in this structure. Their policy options are reactive. They can adjust interest rates, subsidize consumption, or release strategic reserves. But they cannot directly influence production decisions made elsewhere. And this is where the calculation changes. Strategic petroleum reserves, such as those maintained by the United States, are designed to buffer short-term disruptions. According to the U.S. Department of Energy, the Strategic Petroleum Reserve has historically held hundreds of millions of barrels for emergency use. Releases from this reserve can temporarily increase supply and moderate prices. But these reserves are finite. They are not designed to offset sustained production discipline over extended periods. Pause here, because this is where the deeper structure becomes visible. If producers maintain coordinated restraint while demand remains stable, the burden of adjustment shifts entirely to consumers. Economies must absorb higher costs rather than expecting relief from increased supply. This is not a temporary imbalance. It is a managed environment. Now look one layer further. The decision to maintain higher prices intersects with broader geopolitical strategy. For states like Russia, higher global prices partially offset the impact of selling oil at discounted rates to buyers such as China and India. For Gulf producers, elevated prices strengthen fiscal positions and provide leverage in diplomatic negotiations. Energy becomes not only a commodity but a strategic resource deployed in a wider context of influence. And this is where many observers stop their analysis. They focus on supply cuts as isolated economic decisions. They do not extend the analysis to how those decisions reshape power relationships. When energy prices rise and remain elevated, wealth transfers from consuming nations to producing nations. Over time, this alters the balance of financial resources, investment capacity, and geopolitical leverage. This is not sudden, it accumulates. Countries that rely heavily on imports experience sustained outflows of capital, their currencies may weaken, their domestic industries face higher input costs. Their policy flexibility narrows. Meanwhile, exporting nations accumulate revenue that can be reinvested into infrastructure, sovereign wealth funds, and strategic initiatives. This redistribution of resources is rarely discussed in real time. It becomes visible only when its effects are already embedded within the global system. And this leads directly into the second layer, where demand and structure intersect in ways that are less visible but equally decisive. The second angle is not how much oil is consumed, but how demand is structured across different economies. At the surface, global demand appears stable. The International Energy Agency has consistently reported consumption levels exceeding 100 million barrels per day. Growth may fluctuate, but overall demand remains resilient. This resilience supports higher prices. It signals that economies continue to require energy inputs despite rising costs. But demand is not uniform. Advanced economies have, over time, improved energy efficiency and diversified energy sources. Renewable energy adoption, electrification, and policy measures have reduced the intensity of oil consumption relative to economic output. This does not eliminate dependence, but it moderates it. Developing economies, by contrast, often experience increasing energy demand as industrialization and urbanization expand. Countries such as India continue to see rising consumption as infrastructure grows and transportation networks expand. According to publicly available data, India's oil demand has increased steadily over recent years, reflecting economic growth and population dynamics. This creates a divergence. Higher prices affect economies differently depending on their structure. Advanced economies may absorb costs through efficiency gains and policy adjustments. Developing economies face more direct pressure. Energy costs translate quickly into transportation expenses, food prices, and industrial output. And this is where the deeper implication emerges. Demand growth is increasingly concentrated in regions with less capacity to absorb price shocks. This shifts the center of gravity in global energy markets. Producers become more attentive to these growing markets. Pricing strategies may adjust accordingly. Long-term contracts, bilateral agreements, and infrastructure investments begin to reflect this shift. Now consider China. China remains the largest importer of crude oil, with imports exceeding 10 million barrels per day, according to the International Energy Agency. Its demand is shaped by industrial production, transportation, and strategic stockpiling. China has also invested heavily in securing supply through long-term agreements with producers in the Middle East, Russia, and Africa. This introduces another layer. Large importers with strategic planning capacity can mitigate some of the impact of high prices. They can diversify suppliers, negotiate terms, and build reserves. Smaller economies lack this flexibility. They operate within market conditions rather than shaping them. Hold this distinction carefully. It means that rising prices do not affect all consumers equally. They create stratification within the global economy. Some states adapt, others absorb. Now bring in another actor often overlooked. India's role as both a growing consumer and a processor of imported crude introduces complexity. By importing discounted Russian oil and refining it for export, India participates in a layered market structure. It benefits from lower input costs while integrating into global supply chains. This position allows it to navigate between different pricing environments. This is not an anomaly. It is a signal of how the system is evolving. Energy markets are becoming less uniform. Demand is segmented. Pricing is differentiated. Relationships are increasingly bilateral rather than purely market-driven. And this segmentation has consequences. When markets fragment, transparency decreases. Price signals become less consistent. Policy responses become more complex. Governments must interpret a system that no longer operates under a single set of assumptions. This complexity is not temporary. It is structural. And as it deepens, it begins to influence something even more fundamental than supply or demand. Which brings us to the third angle. The third angle is not about energy itself, but about the perception of stability within the system that distributes it. Most analysis assumes that markets react to events. Prices rise when risk increases. Prices fall when stability returns. This assumes a responsive system where cause and effect are relatively direct. But perception introduces delay. Markets do not respond only to what happens. They respond to what participants believe is likely to happen. When perception shifts from temporary disruption to sustained risk, pricing behavior changes. Now consider the current environment. Repeated episodes of tension in key regions, including the Strait of Hormuz, have conditioned markets to expect recurring instability. Even when no immediate disruption occurs, the possibility is priced in. Insurance premiums increase, shipping routes are reassessed. Contracts include higher risk margins. This creates a baseline shift. Prices remain elevated not because supply is currently disrupted, but because participants no longer assume stability will return quickly. This is a psychological adjustment as much as an economic one, and this is where the deeper layer emerges. Stability itself becomes a scarce resource. Countries and companies begin to value predictability over cost minimization. Long-term contracts gain importance. Strategic reserves are reconsidered. Diversification becomes a priority even when it is less efficient. This shift has strategic consequences. Producers capable of offering stable supply gain leverage. Consumers capable of securing long-term agreements reduce exposure. The market becomes less fluid and more structured around relationships. Pause here. This is the point where the system transitions from reactive to anticipatory. When anticipation drives behavior, interventions become less effective. Releasing reserves may lower prices temporarily, but it does not change underlying expectations. Adjusting interest rates may address inflation, but it does not alter energy risk perception. This creates a dilemma for policymakers. Traditional tools address immediate conditions. They are less effective against sustained shifts in perception. Governments must either accept higher baseline prices or attempt structural changes that take years to implement. And this is where the strategic implications extend beyond energy. Higher, more stable price levels influence industrial policy, trade relationships, and even military planning. Energy security becomes integrated into national strategy at a deeper level. Investments shift accordingly. For major powers, this environment presents both challenge and opportunity. The United States must balance its role as both producer and consumer while managing domestic political expectations. China must secure supply while controlling costs within its economic model. Europe must navigate dependency and diversification simultaneously. Each faces constraints, each adapts differently, and as these adaptations accumulate, they reshape the system itself. If this trajectory continues, energy markets will no longer be defined by short-term fluctuations, but by sustained structural conditions that reflect deeper geopolitical realities. And that is where the analysis must now move, toward what these conditions ultimately imply for the future direction of global power and economic stability. If this analysis is reaching you and you are finding value in tracing these patterns carefully, then subscribing and sharing is what allows this work to continue. It ensures that time can be spent examining structures that are often overlooked and presenting them with the clarity they require for serious understanding. The final layer most coverage does not reach is how governments themselves adapt politically when high energy prices stop behaving as temporary events. At the surface level, governments respond in familiar ways. They announce fuel subsidies, they adjust taxes, they release strategic reserves. These actions are visible and immediate. They signal responsiveness. They provide short-term relief, but they do not alter the underlying structure that produced the price environment. They manage the symptoms, not the cause. Now look one level deeper. Sustained elevated energy prices create persistent fiscal pressure. Subsidies must be financed. Budget deficits expand. According to the International Monetary Fund, many emerging economies already carry constrained fiscal space following pandemic-era spending. Additional energy support compounds this pressure. Governments face a choice: absorb the cost and increase debt, or pass the cost to consumers and risk social response. This is not theoretical. Periods of sustained fuel price increases have historically coincided with public unrest in multiple regions. From Latin America to parts of Asia and Africa, adjustments to fuel pricing have triggered demonstrations and political instability. These events are not caused by energy prices alone, but energy prices often act as the immediate catalyst because they affect daily life directly. Pause here, because this is where the internal dimension begins to reshape the external one. When governments anticipate domestic instability, their external behavior changes. Energy importers may prioritize securing long-term supply agreements even at higher cost to ensure predictability. Exporters may use pricing leverage to reinforce diplomatic relationships. Policy decisions become less about efficiency and more about stability. Now consider advanced economies. In Europe, energy price volatility following disruptions in supply chains has already influenced policy direction. Governments have introduced caps, subsidies, and regulatory interventions to protect households and industry. These measures stabilize conditions in the short term but create longer-term fiscal commitments. They also distort market signals, complicating future adjustments. The United States operates under a different structure, yet it is not immune. Fuel prices are politically sensitive. They influence public perception of economic performance. They affect transportation costs, food prices, and inflation expectations. Political cycles amplify this sensitivity. Policy responses may therefore be shaped not only by economic logic, but by electoral considerations. This introduces a constraint. Governments cannot always pursue optimal economic strategies if those strategies carry immediate political cost. They may delay necessary adjustments. They may intervene in markets in ways that provide temporary relief but increase long-term complexity. Now look one layer deeper again. Sustained high energy prices accelerate structural policy shifts. Investment in alternative energy sources increases. Efficiency measures gain urgency. Supply diversification becomes a strategic priority rather than a long-term goal. These changes do not occur overnight, but once initiated, they alter future demand patterns. This creates a paradox. High prices benefit producers in the short term, but over time they incentivize consumers to reduce dependence. The higher the price persists, the stronger the incentive to transition. This dynamic introduces a delayed feedback loop into the system. Exporting nations must consider this. Maximizing revenue today may accelerate demand reduction tomorrow. Balancing these timelines requires strategic calculation. It is not simply about current price levels. It is about long-term market position, and this is where the system reveals its complexity. Domestic politics, fiscal capacity, and long-term strategy intersect. Each government operates within constraints that shape its response. These responses collectively influence the global system. No single actor controls the outcome. It emerges from interaction. This is the layer that connects internal stability with external behavior. And it leads directly into the final synthesis of what all of this means when viewed together. So what does all of this actually tell us? The price level itself is only the surface expression of a deeper structure that is adjusting under pressure from multiple directions at once. Coordinated supply management by OPEC+ constrains availability while maintaining revenue objectives. Global demand remains above 100 million barrels per day, according to the U.S. Energy Information Administration, sustaining upward pressure even as costs rise. At the same time, consumption patterns are shifting, with emerging economies driving incremental demand while advanced economies attempt to moderate exposure through efficiency and diversification. Overlay this with changing expectations. Markets no longer assume rapid return to lower price ranges. Risk is embedded into pricing as a persistent condition rather than a temporary anomaly. This alters investment behavior, contract structures, and policy responses across the system. Governments intervene, but their interventions reflect political and fiscal constraints as much as economic logic. Add the final layer. Domestic pressures within importing countries influence external strategy, while exporting countries balance immediate revenue against long-term demand erosion. Each decision feeds back into the system, reinforcing the conditions that sustain elevated prices. This is not a single cycle. It is an interaction of structures. Energy markets, political systems, and strategic behavior are now moving together rather than independently. The result is a new baseline defined less by short-term fluctuation and more by sustained tension between supply discipline, resilient demand, and constrained policy options. And before this analysis ends, there is one more thing that needs to be said clearly. The evidence points toward persistence rather than rapid reversal. What matters now is not whether prices fluctuate, but whether the underlying conditions that support them begin to shift. Watch production decisions within OPEC+, and whether coordinated restraint continues at current levels. Observe demand signals from major consumers such as China and India, particularly any indication of sustained slowdown or structural change. And monitor policy responses in large importing economies, especially whether governments transition from temporary support measures to long-term structural adjustments. These indicators will not move simultaneously. They will interact, and their interaction will determine whether the current environment stabilizes, intensifies, or gradually transforms into something different. Uncertainty remains. It cannot be removed, but it can be observed with clarity. This is not a moment defined by a single event, but by the accumulation of decisions that are reshaping how energy, economics, and politics intersect. This analysis is provided for educational and informational purposes only. Nothing presented here constitutes policy advice, intelligence assessment, or advocacy for any government or political position. The perspectives expressed are based on publicly available information from credible international sources and represent an independent analytical interpretation. The voiceover used in this video is generated using artificial intelligence technology. Viewers are encouraged to consult multiple sources, verify data independently, and form their own conclusions regarding the issues discussed throughout this analysis. Understanding how these systems operate is not an abstract exercise. It shapes how you interpret events, how you assess risk, and how you anticipate change. Share this with one person who is paying attention but has not yet seen the underlying structure. Leave a comment with your own assessment or the country you are watching most closely. The algorithm responds to engagement, and that engagement determines whether analysis of this depth continues to reach those who seek it. The next shift will not be announced when it begins. I am Professor Liang Wu. Stay curious, stay skeptical, and never mistake a quiet news day for the absence of history being made.